Last week we got very important economic data, PCE, coming in a little hotter than the markets are hoping for. The Federal Reserve has been actively reducing interest rates, moving down to about 4.5 to 4.75 on the short-term interest rate. And this is because they feel as if inflation is going to hit their target rate of 2%. Now all of a sudden we're looking at these data points and saying maybe not. What's going to happen with the stock market based on inflation? What will the Fed do next? Fact is, there's a lot of heat in this economy. And I'm talking specifically about the money supply. There's plenty of money and it is growing. This money supply will aggravate inflation probably in the medium term. From there, if we get tariffs, believe it or not, this may actually be a bright side to the inflation picture because tariffs will tax consumers and this will lower aggregate growth as well as inflationary pressures. Let me show you what's happening with the economic data I'm looking at right now and why I think the stock market is going to continue to move higher for some period of time, but then we may hit some turbulence in the medium to long term. Let's jump in. Here's a look at the S&P 500. This is roughly, I want to say, late summer 2019 to present. And as you can see in 2020, of course, we fell off the cliff because of COVID. Then the Federal Reserve kicked in, lowered interest rates, started buying up debt, printing money like crazy. You can see the effects of that. Went a little bit sideways. We didn't get much growth after that. But then if you recall, October 2023, we started to sell off on the S&P 500 because we were starting to see some inflation numbers. And the Federal Reserve, we weren't quite certain what their reaction was going to be. It was a small sell-off for the S&P 500, but since then it has taken off. S&P 500, the stock market, broadly speaking, has been taking off significantly. You can see how much it's taken off. Where do we go from here? Now, I want to show you the S&P 500. Here is a look at the year-over-year change. Now, we're clearly above outside bands, if you will, when you're looking at this chart. Year over year. Now you always see or read about individuals or news agencies talking about the 1 year growth rate. Well, this is the entire, all the way back to 1990, what it looks like. And this is important because I'm going to show you the same exact chart a little bit later versus the money supply. When the money supply is growing, oddly enough, the economy and the stock market do exactly the same. Now, just because we're well above this trend line area where you could say normal, the medium is probably about 10 to 15%. And we're clearly above the 25% level. That does not necessarily mean a stock market sell-off as much as it means that we could be moving sideways at some point or lower, but that we continue to see the stock market moving up just slowly. That's something important to keep in mind. Here's your PCE deflator. The PCE inflation, as you can see, kind of popped up a little bit over the last week. We got the numbers. Now, this is something that the Federal Reserve looks at more so than the CPI. The thing about the CPI is the two baskets are roughly about the same. CPI inflation comes out about 2 weeks prior to PCE. So it kind of gives us a heads up as to what we could see in the PCE inflation deflator. They're very similar. If I overlaid the year-over-year charts on both of these, it's hard to tell which one's which. But it's not 100%. Now here's the core. This strips out, of course, food and energy, which are very volatile from one period of time to the next. We're starting to pop back upwards. The remaining 3 or 6 months, the past 6 months, I think I busted out a calculator and I asked the question, what is the rate of change for these last 6 months? It's about 2.68% on average for these 6 months. So should we continue at this level, the Federal Reserve is not going to be exactly thrilled to death. They want to hit 2%, maybe lower. We were sliding downward significantly, but now we're kind of sliding sideways, and it's still too high for the Fed's target rate. I don't necessarily think that this inflation report is really sort of a nail in a coffin or anything like that. I think that there are some outlying occurrences within the inflation number I don't think this necessarily means that the Federal Reserve will increase interest rates, but they certainly will pause. Now, prior to the presidential election, if you had been following me all through the spring and summer, I had repeatedly said the Federal Reserve won't get in front of the presidential election and lower interest rates. Number one, because of the presidential election, and they don't want to appear as if they are favoring one side or the other. Number two, I did not believe that the economy was weak enough to lower interest rates. The Federal Reserve, of course, has lowered interest rates 2 times now, and I believe they were too early on that. And as it turns out, that might be playing out. The money supply is really what I keep going back to, because the money supply, here's the year-over-year change in the money supply. We're getting closer and closer to median. We're still well below. But the rate of growth, the rate of change is accelerating higher and higher. We may overshoot, the money supply may overshoot the median level. Here's the thing about the money supply. We're a fractional banking system. Whenever a new loan is being created because of reserves in a banking system, that increases the money supply. So if we're seeing a rate of growth that is increasing as fast as this is, that tells me that the price of money is too low, meaning interest rates are too low. So at the very least, the Federal Reserve is going to have to pump the brakes on lowering interest rates. At the very most, it could be prompted to raise interest rates, but I believe there's an asterisk to that, and it is the tariffs. Now, core PCE versus M2 money supply, I inverted inflation on this chart. You can see clearly that inflation and the money supply go hand in hand, but this is inverted. And why did I invert this? It's really simple. If the economy is expanding, we're seeing more and more money. That would, of course, push inflation, but you have to invert the chart to actually see it. But you can see how closely related money supply and inflation is. With the money supply shooting up as high as it is, the fact that the inflation rate has only moved up as much as it has in the past couple releases is, to me, kind of, you need to be on alert, because very easily we could see a big spike up in inflation in the next 2 or 3 months. As long as nothing, say, adverse were to happen to the economy, such as maybe January 21st, we get tariffs across the board. Now, the tariff thing, it's a tax, plain and simple. And if you tax, what is it? What's he talking? 25% tax on goods coming into the United States from Canada and Mexico. 10% across the board to start with China, but then I think he's going to try and do some other things in other areas. Consumers pay that tax. It is a tax. We already have tariffs. Now, tariffs themselves are less than 1%. They're nominal at best. These take care of administrative costs and things like this, because the port entry fees and things like that. That's what those are being paid. That's where that tariff money goes to now. But Trump, of course, is talking about jacking up tariffs to 25%. Now, any company that's importing anything, and let's say let's say they bring in 10,000 units at $10 a unit, with a 25% tax on that unit item would be $12.50 per unit. That $2.50 extra gets passed on to consumers, of course. But there's going to be profit margins in between. There's going to be costs of transporting these items from, say, California ports all the way to Kansas, wherever. So what we're looking at, the end result is that $10 item will get an extra 25% increase in tariffs, $2.50, but it may be being sold in Michigan for, say, $40. So it's much less when you look at the end retail price. And I keep hearing all these numbers on social media, People are saying everything you buy is going up 25%. Not true. There will be some things such as oil where there isn't as much markup per se, where you might see that. Regardless, that is a tax that the consumer will pay. So there will be an increase in taxes. That removes money out of the system, which means that could halt very quickly inflation and the money supply. So while on the one hand I see the money supply moving higher and higher, there is something that could be pushing it down more and more. Back to this chart, the S&P 500 in blue versus the M2 money supply. When the money supply is growing, businesses are taking out loans to expand industries, expand whatever services they're providing. All right, this increases the money supply on a continual basis, and as you can see that the money supply and the S&P 500, the chart I showed you earlier, it's overlaid right here, the year-over-year growth rate correlates kind of strongly with the M2 money supply. So we're seeing this big surge higher in the money supply growth rate. We're also seeing that surge higher in the S&P 500. I don't see anything stopping the money supply from growing right now today. January 20th, things could get a little more interesting, but it will take some 3, 4, 6 months before they really start working into the economy. So in the meantime, the S&P 500, the stock market, broadly speaking, the Dow, NASDAQ, and individual stocks within there, really don't have any reason to slow down at this point. But what if we also get inflation numbers starting to move higher and higher? Then all of a sudden, you might get a lot of traders starting to hit the sell button, rushing for the door. The nice thing about that is Treasury bonds would start to rally a bit and yields there, and the Treasuries would fall because of safe haven investors looking for safe haven there. So that could be an interesting development. Given where we are today, if we weren't to see any tariffs, we'll see what he does. There's nothing stopping this M2 money supply from continually growing, which with a correlation on the stock market, the S&P 500, Dow, NASDAQ, the stock market could continue higher and higher. But we could also eventually start seeing inflation numbers moving higher and higher. So we got this sort of balancing act that's likely to happen based on if the tariffs do come. Because if the tariffs do come, the Federal Reserve really won't have anything to do. They'll take a wait-and-see approach. But initially, all that money being consumed by the U.S. government in the form of taxation would dampen aggregate growth and reduce the growth rate in the money supply, which would mean the S&P 500, although for some period of time is going to continue to move higher and higher with its growth rate, eventually will contract along with the money supply. Got to keep your eye on these things because this is one of those indicators that really could be that one indicator that can get you ahead of the curve. Jobs. We get jobs reports, on Friday this week. This is continued jobs claims. And as you can see, continued jobs claims have been kind of elevated somewhat. But this is kind of elevated somewhat off of historically 60-year lows. So although we are seeing moves higher, they're not necessarily a symptom or a signal that we're going to see terrible numbers come Friday. I've seen some reports that they're looking for about 200,000 non-farm payroll prints. If we do see that, you can expect the stock market to really start taking off. That would really start to propel this economy further because what happens is if you do add 200,000 new jobs to the economy, that's 200,000 new individuals earning income and spending that money, which would prompt businesses to start the borrowing process, expanding this economy further, pushing the fractional banking system further, which would continue to increase the M2 money supply. Then, of course, the correlation to the stock market. The stock market could very easily continue higher. And this Friday, we could get some interesting information as to what that could look like. My take, we still don't know about what's going to happen with tariffs. If we do see tariffs, I think the stock market will continue to move higher for some period of time. I think the stock market could weather some of that, and it may be that the tariffs could alleviate a lot of sort of friction for the Federal Reserve, and the interest rate levels could remain where they are for some period of time. I feel as if they've lowered them too fast, too early. Any of my videos from previous, I basically kept saying, no, they'd never do this in front of the presidential election, and the economy's too strong. It kind of makes you wonder who he was voting for, or who the Fed was voting for. Could they have juiced the economy a little bit simply out of favoritism? I think that it was too premature. The data tells me that. And now we look like it was true. Make sure to hit that like and follow button. Make sure to hit my, I have a Substack newsletter where I explain all this in written form if that's something you're looking for. We'll see you in the next video.